Ever wondered what Forex trading is and how it works? Let's dive into the basics. Forex, short for foreign exchange, is the world's largest financial market where currencies are bought and sold. In this vast marketplace, transactions are made in currency pairs. For example, if you're trading the euro against the US dollar, that's a currency pair. Now, on to bid-ask prices. The bid price is the amount you're willing to pay for a currency, and the ask price is the amount you'll accept to sell it. The difference between these two prices is known as the spread. Lastly, let's touch on leverage. Leverage in Forex trading is a tool that allows traders to control larger amounts of money than what's available in their trading account. It's a double-edged sword. It can amplify both profits and losses. For a more detailed explanation, check out our beginner's guide linked in the description below. With a solid understanding of the basics, you're now ready to delve deeper into Forex trading. Technical analysis is a trader's compass. It helps predict where the market might go next. We can think of technical analysis as a sort of financial archaeology. It's about digging deep into the historical price charts and using that information to make educated guesses about future price movements. It's not about crystal balls or fortune telling, but about recognizing patterns and trends from the past and applying them to the present. Now let's dive into some essential tools of technical analysis. First up, we have trendlines. Trendlines are simple yet powerful tools that traders use to identify and visualize the direction of a market's price movement. By drawing a line that connects multiple price points, we can determine whether a market is trending upwards, downwards, or moving sideways. Next, we have the concepts of support and resistance. Think of these as the floor and ceiling of a market. The support level is where the price tends to find a floor and bounces back up, while the resistance level is like a ceiling that the price hits before falling back down. Identifying these levels can help traders predict potential price reversals and breakout opportunities. Moving on, let's talk about some popular indicators, starting with moving averages. This indicator smoothens out price data to help traders identify the market's underlying trend. It's like looking at the forest instead of focusing on individual trees. Another popular indicator is the Relative Strength Index, or RSI, which measures the speed and change of price movements. It's a great tool for identifying overbought or oversold conditions. But remember, these tools are not standalone solutions. They should be used together to form a comprehensive trading plan. Consider factors like your risk tolerance, your trading goals, and the current market conditions when creating your plan. A well-constructed trading plan can help you stay disciplined and avoid impulsive decisions. Mastering technical analysis can greatly improve your trading performance. Remember, practice makes perfect. So keep studying, keep practicing, and keep refining your skills. After all, every successful trader was once a beginner who never gave up. In Forex trading, it's crucial to keep a finger on the pulse of the global economy. Welcome to the world of fundamental analysis. With the rapid pace of today's markets, understanding the forces that drive currency prices is essential. That's where fundamental analysis comes in. It's all about studying the economic, social, and political forces that may affect currency supply and demand. One of the key aspects of fundamental analysis is understanding economic indicators. These are reports that governments and private sector organizations release, providing a snapshot of a country's economic health. They include data on things like GDP growth, inflation, employment, and consumer sentiment. These indicators can have a profound impact on market prices, and as a trader, it's important to be aware of them. Interest rates are another significant factor. Central banks set interest rates to manage inflation and stabilize their economies. A higher interest rate typically strengthens a country's currency as it attracts foreign investors looking for higher returns. Conversely, lower interest rates can weaken a currency. Staying updated with central bank statements can provide important clues about future interest rate changes. Geopolitical events also play a big part in currency movements. Elections, changes in government policies, trade wars, or conflict can create market volatility and influence currency values. Keeping an eye on global news and understanding its potential impact on the markets is a key part of fundamental analysis. Now, how do you incorporate all this information into your trading strategy? One useful tool is the economic calendar. It lists the dates and times of major economic events and indicators, allowing you to anticipate potential market movements. News releases, such as those from central banks, can also cause significant price swings. By incorporating these into your strategy, you can position yourself to take advantage of market volatility. Remember, a well-rounded trader doesn't just look at price charts. They also consider the broader economic and political landscape. Combining technical and fundamental analysis can give you a comprehensive view of the market. And with that, you're one step closer to becoming a successful Forex trader. In trading, sometimes the best offense is a good defense. Let's talk about risk management. Risk management, in essence, is the art of not losing. It's the safety net that catches you when the market doesn't behave as you expected. Let's think about stop-loss orders. Imagine you're walking a tightrope. A stop-loss order is like a safety net, ready to catch you if you slip. By setting a stop-loss order, you're deciding in advance how much you're willing to risk on a trade. It's like an insurance policy against market volatility. Now let's talk about position sizing. It's the size of your trade in relation to your total trading account. Position sizing is like deciding how much to bet on a horse race. You wouldn't put all your money on one horse, would you? The same applies to trading. By properly sizing your trades, you ensure you live to trade another day, even if the market takes an unexpected turn. And finally, let's discuss the 2% rule. This rule suggests that you should never risk more than 2% of your account on a single trade. It's a rule of thumb that helps you stay in the game, even when things don't go your way. Remember, successful trading is not only about the profits you make, but also about the losses you avoid. A ship without a compass is bound to get lost. The same goes for a trader without a strategy. So let's delve into the world of trading strategies. A strategy is essentially a set of rules and guidelines that dictate your trading decisions. It's your game plan, your playbook, if you will. There are various trading styles you can explore, each with its unique characteristics and requirements. For instance, day trading involves buying and selling within a single trading day. It's fast-paced and requires constant attention. On the other hand, swing trading is a medium-term strategy where trades last from a few days to a couple of weeks. It's less intensive than day trading but still calls for regular monitoring. And then we have position trading. This is a long-term strategy where trades can last from several weeks to months or even years. It's less time-consuming but requires a solid understanding of fundamental analysis. Now, for beginners, we recommend a simple yet effective strategy. Start with a single currency pair. Understand its behavior. Use a combination of basic technical analysis tools like trend lines and moving averages, along with keeping an eye on key economic indicators. Remember, the goal is not to make a fortune overnight, but to make consistent profits over time. A well-crafted trading strategy is your roadmap to success in Forex trading. So take your time to develop one that suits your trading style, risk tolerance, and financial goals. Enough of theory, let's jump into action. It's time for a live trading demonstration. Imagine we're looking at a currency pair, say the euro and the US dollar. The technical analysis shows a strong upward trend, and our fundamental analysis indicates stable economic conditions. We decide it's a good time to buy. Firstly, we set our position size, mindful not to risk more than 2% of our capital. We then place our order, not forgetting to set a stop-loss order to manage our risk. As the market evolves, we keep a close eye on our trade, ready to close our position once our profit target is hit or if the market shows signs of reversing. Remember, no two trades are the same. Markets are dynamic and conditions can change swiftly. It's crucial to stay flexible and adapt your strategy accordingly. See, with a little practice, you can navigate the Forex market like a pro. Before we wrap up, let's recap the key points we've covered today. We started with the basics of Forex trading, diving into the nitty-gritty of currency pairs, bid-ask prices, and how to leverage these in your trading. Then, we explored the world of technical analysis, discussing the importance of trend lines, support and resistance, and key indicators. We also touched on fundamental analysis, where we emphasized understanding economic indicators and geopolitical events. And of course, we didn't forget about risk management, a critical aspect of trading that's all about protecting your capital. Lastly, We showcased a live trading demonstration to help apply these concepts in real-world scenarios. If you have any questions or need further clarification on any of these points, feel free to leave a comment below. I'll make sure to address them in our upcoming Q&A sessions. Don't forget to hit the like button if you found this video helpful and share it with your fellow traders. Until next time, trade wisely and stay profitable.